Now that property, we actually bought it for $440,000 back in 2004, which is
Yes.
amazing price for that area. If we look back now, and it probably rose in value up to probably around 1.2, 1.3 million at some stage.
You're listening to Property Investor Tales, stories from the front yard.
Hello and welcome to Property Investor Tales, stories from the front yard, where I get to speak to property investors from around Australia about their investing journey. My name is Tabitha Bright and I'm the Head of Advising here at Positive Real Estate, where we help people build wealth through property. With over 8,000 clients across Australia and New Zealand, there are some incredible stories to tell, which hopefully make your investing journey that little bit easier and will inspire you along the way. So my guest today is Howard Bird, a newly anointed coach here at Positive Real Estate and a long-term client. And we talk about his journey with property today, how he used off-the-plan purchasing as a strategy to buy multiple properties safely, the awesome results he got from that, and how divorce doesn't have to be the end of your options financially. Howard's recovery is certainly inspiring. So enjoy this conversation with Howard. Hey everyone, Tabitha here from Positive Real Estate and welcome to the podcast. Today I have our client Howard with us, and Howard Bird has been part of the program. Actually, Howard, going a little bit off script here, how long have you been part of the program?
Yeah, thanks for having me, Tab. Yeah, I've came in with Positive Real Estate as a client around 2018, late 2018. Yeah.
Oh yeah, good. So you guys can do the maths on that. It's 2024 at the moment. So what's that, 6 years?
That'll be 6 years, yeah, coming up.
Yeah, I had to get the old grey matter working on that one. And Howard has also recently joined the team as one of our coaches, which we're really excited to have him here and on board and ready to share a lot of his expert knowledge, because Howard has a background not only in property investing but also in finance, and he's been working in finance for many years. So we'll talk a little bit about that. But before we get into that, I always like to share some more personal stories, I guess, Howard, rather than a CV per se.
Right.
So I was like, God damn, she's got me now. So tell me a little bit, what has been your experience with property? The floor is yours, my friend.
Yeah, look, like everyone, grew up in a house, so that's a good start.
Most people, yep.
Yeah, most people who will be listening in here, I guess, would have done that. Look, I first became a homeowner back in 2004, so 20 years ago. I was married at the time, married now, but different wife. But yeah, we brought a lovely Victorian-style double-fronted property in Northcote. So, for those who don't know, it's in Melbourne, about 5 k's north of Melbourne, very trendy part of the city, or part of Melbourne these days. That was pre-up and coming, so we sort of got in early. A little bit of luck. We were looking at other areas at the time, but Richmond. We sort of lived in the inner city areas already, but Richmond was affordable, but very small houses, and so got a brochure or one of the books from one of the real estate agents. Go, oh, that looks like a nice house. Northcote, where's that? Oh yeah, not too far. Let's go check it out. And brought it at auction. It's been a few years there. So
Very good. Because it does take me back. For a lot of people that are investing today, it would be very foreign, but I remember getting subscriptions to newspapers out interstate so that I could trawl through the real estate ads to look for opportunity, because not all the ads were on the internet when I first started investing. That's how old I am. And I do remember, I know they still have the books, but you'd get the books from the agents and you'd trawl through those and have a look at the pictures. And there wasn't as much of an online presence, whereas today, obviously, realestate.com.au and Domain and those kind of websites rule the roost pretty much, don't they, when they come to real estate. And so you got a good result with that. Obviously, you talk in your story on the information nights that people can attend to hear more about investing. You talk a little bit about how that marriage wrapped up and you had to sell the house and start again. So tell us a little bit about that.
Yeah, look, it's probably a familiar story to many people. They say about 40% of people who get married, unfortunately, don't go the distance. So it's not an unusual place to be in. But yeah, look, we did.
Not at all.
Yeah, we did get some equity in that property. A few years in 2009, we did actually look at start investing. I did a lot of running around. I was on the Gold Coast at the time working for Caterpillar, and I drove down to Sydney a couple of times because it wasn't that busy. It was sort of GFC time, and I was looking around, Potts Point. For those who know Sydney, a very nice area, not far from the CBD, and I wanted to buy a couple of smaller apartments there, but we got sidetracked and actually bought a house in a town called Mooroopna, which is near Shepparton in Victoria, a couple of hours from Melbourne, because my ex's parents lived there. So we brought a little place there, not the best investment. So that's one of my stories of woe a little bit. But yeah, a couple of years after that, unfortunately we separated and got divorced, sold up the house in Northcote. I think it was around 2013. So we had a child from that marriage. So as most do, we came to a private agreement, but most of the money went to my ex-wife to buy a new house for her and her daughter, who spends most of the time with her. But luckily, we ended on reasonably good terms. So I had enough money come out of it in my pocket. So a little bit luckier than some or most even, to have $80,000, so enough for a 20% deposit on a property. So that sort of sat in my account for a little while. Yeah.
Right. Yes, often it's the lawyers that benefit the most, I think, in those circumstances, if you're not able to maintain good terms. Yes, I do hear. I think coaching, you'll hear me roll this term out a lot, coaching for over 16 years, it's going to be, dug into my gravestone. She coached for over 16 years. I've seen people from all walks of life and all financial situations, and the overwhelming feedback is when it comes to divorce, it's the solicitors that definitely get the better outcome if it's not able to be kept amicable. And so, tell me a little bit about your story of woe, because funnily enough, we learn the most from our mistakes, and I've shared a few of my woeful tales. So what happened there? What was the result? What did you learn from that regional property purchase?
Yeah, look, so we actually, after the divorce, we actually kept that. It was basically paying for itself. We'd set it up that the ex-in-laws were paying the rent sort of in line with the mortgage at market rate still, which is important for tax reasons. We won't go into that today, of course, or maybe we will later. So that sort of paid its way. So we left that running in the background for quite a few years. We only it was only actually sold 2 or 3 years ago. That was in. Oh, yep. We brought it only in my wife's name, but the loan was in both names, so I was sort of still on the hook for that as well. So that was put it maybe a little bit of a crimp in some of my borrowing capacity earlier on, but we got past that. But I guess the main thing I found, probably the biggest lesson I found from that, because as I said, it was around GFC time, so there was a lot of uncertainty in property markets and financial markets and that sort of stuff. So that property, we actually brought it for $440,000 back in 2004, which is amazing price for that area. If we look back now, and it probably rose in value up to probably around 1.2, 1.3 million at some stage. But by the time we got to sell, because of circumstances, we were forced to sell because of where we ended up. We ended up selling it for around 850, something like that. So I guess one of the big, so it's still a good result, obviously. Yeah. By most measures, but it's just I guess the good lesson from that is you can't really you need to be able to be in control of these things, when you buy, when you sell. That's one of the big things that we obviously teach here, is that there's those macro influences that you have no control over. So,
Yeah. And it's interesting too. I mean, as far as a tale of woe goes, I don't mean to to minimise how that must have felt. It is, it's still a pretty good outcome, which is awesome, because we don't wish a bad outcome on you. the interesting thing is the choice to be able to sell, like you just said. And as soon as we're forced to sell, and often when we see clients' portfolios, I have a client at the moment that I catch up with every quarter, and he's been an absolute champ, and we're managing his cash flow within an nth of its life. He's purchased a number of properties, and some of them were prior to Positive Real Estate, and they were in small regional towns, and the value of them is halved, and with interest rates increasing and his job being a little bit more tenuous, it's had a real impact on him financially. If he can hold the stuff that he's bought with Positive Real Estate is beginning to perform really well now. But of course, if he was to sell, the regional markets still haven't caught up with where he originally purchased. So it means that you sell your best performing property to prop up your worst performing property when you're in that position of being forced to sell. So we're literally every quarter I catch up with him. I check what buffers he's got, what he's been spending, whether we can get rents up. What leverage we've got so that he can continue to hold, because the regional markets he's in are actually beginning to gather a little bit of speed.
Yeah.
And if we can just keep him holding for 1 or 2 more years, he's going to be in a very different position, which I'm sure will provide a lot of relief. But it is that control. Everything's about control when it comes to real estate. It's what you control. And so tell me, what do your friends and family think about your investing? Or do they not know?
No, look, I think probably more, from my background in banking and finance, all my colleagues knew I was, very, very keen on property. I ended up, the role that I ended up in was called head of credit risk oversight. So, pretty high level, role in a bank, responsible manager for the bank, all that sort of fun stuff. So, so those people knew that I was, very keen on property, and I was a go-to for many things across property and finance. So look, and they were really encouraging when I moved on to come into this role here with Positive Real Estate, because they said that's perfect for you. All you talk about is property and finance and structure and tax. So
that's awesome.
So I've got good people around me. I don't from my friends' perspective, we don't really talk about it that much, but most of my friends have got varying levels of success. So they're luckily I'm surrounded by people with good mindsets around money and building wealth. It's not like a lot of people where there's the tall poppy syndrome, where people say, oh, you can't do this, you can't do that, you shouldn't do this, you shouldn't do that. So pretty really lucky common from that perspective.
Yeah. Well, we design our own luck. So, it's credit to you. And part of the reason that, we were keen to have you on board at Positive Real Estate is that, every coach brings their own secret sauce or expertise. I like to call myself a generalist. I have the general big picture, tend to be big picture. I can get into detail if I need to. And for yourself, your expertise in finance and your calm under pressure. I don't think I've ever seen you flustered. Even when I knew you as a client, I don't think I've ever seen you particularly flustered or upset about everything. You take everything in your stride, and I think that's a really important thing to have when you're a coach, is that ability to be calm in front of uncertainty, because a lot of people don't invest because of the fear, and they have what we call the seagulls. It's not a phrase I invented. It's I think it's I was going to say Bob Proctor, but it's one of those old school self-development guys used to talk about the seagulls. Everyone all It was my best impression of a seagull. I'm sorry to say it's being recorded. That squawk at you and tell you all the reasons why you can't do something. So to design a group of friends and attract a group of friends that are of similar mindset, because what's that old saying they have, you might be able to remember it, about you are the, whatever percentage of the people that you hang around.
Or to sum the closest five or something like that,
Yeah.
So People like to mirror, other people. So it's part of being accepted as part of society, right? That you don't want to be an ally. You don't want to be in the corner by yourself. So you mirror those around you to a certain extent.
Well, it is about community, isn't
Yeah.
it? And I think that's what attracts a lot of people to positive real estate is that community vibe. And certainly I know people are keen for us to get back into the face-to-face events. So we've got a bus tour coming up this Friday, which I'm a bit pumped about. It'll be nice
I'm excited to be on the bus too, yeah.
I know you have been one of the people that have been saying, Tab, it'd be great to have some live events again. And I think it is echoed by our community. So post-COVID, we're getting into the swing of it, I think. Even mentioning COVID now seems like an age away. So when you think about your investing journey, what would have been the biggest lessons, do you think, that you would like to share with somebody that was thinking about getting started investing? What are some of the things that are important?
Yeah, look, I think I've probably hit, many of the roadblocks that most people do. Obviously, there's the personal family side of stuff where I had the issues, but by nature I'm a very analytical person as well.
Right.
So I tend to read a lot, take in a lot of facts, counterpoints, counterfacts, and just overanalyze things. So analysis paralysis has been one of the big lessons for me during my time. Obviously, it took me, I brought my house back in 2004, got into investment in 2009, but didn't have really people around me at that stage to assist me. We didn't join up with Positive until 2018, and we'll talk about it a little bit later probably, but really accelerated my journey. So I think the most important thing is partly taking a chance, jumping in a little bit, but making sure you have people around you who can assist you with that. You can't be similarly to you, I'm a little bit of a generalist, but also specialising in the finance piece as well. I like to understand where everything fits together. But they often say if you're the smartest person in the room or the smartest person in the team, you could be in trouble as well. So you need to have those experts around you as well. I think education is very important as well in terms of you need to know enough to be able to ask informed questions as well. You rely, you ask the right questions, you'll get better answers, and allow you to fact find a little bit as well, and sort out the good from the bad as well. So I think education's one of the things that I'm very keen on. That's why I'm here as well, working for Positive Real Estate.
Oh no, I think. Sorry, Howard, I didn't mean to interrupt you.
No.
I think everyone will benefit from a lot of your knowledge, especially around that finance stuff. And so, I guess tell us a little bit more about your investments. So you purchased the Northcote property, which was your principal place of residence. That got some good growth. You sold that due to personal circumstances, and you obviously cleared the decks with the regional property. So originally from Northcote, you came out with about 80K after the divorce. And then what did you do with that? What was the first deal that you bought?
Yeah, so did a house and land package in Brisbane, suburb called Griffin, so in the northern suburbs of Brisbane. That was around 2014. So jumped into that with we won't mention any names, but a different property group. And so looked up that was an interesting one. Just jumped in the market. I've paid around $450, $460, I think, for that. From memory, I actually went. I did a 90% lend on that one. Went with some LMI on that because I'd enjoyed some of my cash for some other things as well. But that property sort of didn't do much for a couple of years, 2 or 3 years. The Brisbane market, we always talk about Brisbane. Brisbane's taken off recently, but it was always the next big thing for probably 4 or 5 years. It sat in its consolidation phase for quite a while, didn't do a lot. So patience is a virtue in property, and that's one of the big lessons that I learned there. My rents were okay. It was pretty much almost paying for itself, a little bit out of pocket, which is often the case. But I was pretty keen to build my portfolio, but not much was happening. So, again, that, went back into, okay, I have all this time on my hands. I love property, so I'm reading more, I'm learning more, and then, taking on all this additional information, which is probably not good for me because then the analysis paralysis comes in again. So,
Yeah.
yeah.
And so then how did you buy your next property? What happened?
Yeah, so probably it was about 3 or 4 years in, so I think around 2018. By that time I had repartnered,
No.
so I had a new partner, and we'd actually brought an apartment together in Melbourne CBD. She's my now wife is from Hong Kong, so she likes apartment living. I love living in the city. When I moved out of the family home, I actually moved in with a friend in Melbourne CBD. So
That's cool.
been there for 10 years. So we brought a property together with some assistance from her mum in Hong Kong. So she essentially paid for our deposit because she wanted her daughter to get some roots in Australia. So that was another little bit of luck on our side. And then around that time we brought another. We also brought. The way we work, we were very good on saving as well. So. One of the key lessons is around budgeting, and we put away 30% of our salary, 10% of that for travel because we like to travel, and the rest was going into offsets against our loan. And then we saw another house and land package that we jumped on as well. So we had that was around 2018. We brought our first investment property together, my second investment property. So that's awesome. That was good.
Where was that?
Again, another one in northern suburbs of Brisbane, a little bit further out in Burpengary, because that's where our price point was. We like that, that $450,000 to $500,000 price point. You can get a pretty good quality asset at a pretty good price as well. So that's it was a nice balance. So that's where we went with that. So
fantastic. So now you've got 2 houses.
Yeah.
Plus your apartment in the CBD, which
Correct,
is pretty cool.
Yeah.
And I like how you structured that, because sometimes people are put off with investing because they feel that it's all or nothing. Like if they build a portfolio, then they don't get to do the other things that are important in life. And one of the key things that we do, first of all, when our clients start the mentoring and coaching program, we call it our lifetime mentoring or portfolio builder, because we teach people actually how to build portfolios. And an important part of that is the goal setting. And sometimes people, when I say, okay, I'll get you to complete your goals, and everyone goes, rolls their eyes. I don't want to do goals, or I don't know what my goals are. I think sometimes we have this resistance to doing goals because it's like you're being held accountable or tied down to something. And are you reaching too far, or have you not stretched enough? It can be a bit of an uncomfortable experience sometimes for people.
Yeah.
And so I found a bit of resistance. But what I like about what you and your wife have done is it's awesome, because you're saving that 30%, which is really cool, but 10% of that is going to life experiences and the stuff that's important to you. So it's not all or nothing. And I think that's really key. I always used to make people reward themselves, pick a reward in some way, shape or form when their property performed, when they were able to get equity out of it, when it's turned cash flow positive. Like, it doesn't have to be go on a 40 grand trip around the world. It might just be have a weekend away or a nice dinner or something. But we have to celebrate, because another thing I've noticed after 16 years of coaching, you're going to get so sick of hearing me say that, is that we get in the habit of just ticking and flicking. We tick off a goal and we just move on to the next thing, and we don't actually stop and celebrate. So I love that about you guys. Have you been on any trips lately?
Not recently. Not really since COVID, unfortunately. But I do have we have a 5-year-old at home. As I mentioned, my wife's from Hong Kong, so she'll go back to Hong Kong once a year for 2 or 3 weeks. Sometimes I go, sometimes I'll stay here and stay in Melbourne, sunny Melbourne, because it's normally in the summertime, and I love the sun. So.
Oh, fantastic.
Yeah.
Oh, you and I are polar opposites there. I love winter. I know people think I'm mad, but it makes running easier in winter. But once again, people will roll their eyes when they hear me talk about running. What else? What happened next?
Okay. So I guess we got pregnant, or my wife got pregnant. Takes two to tango, so we got pregnant.
Yes.
And that was around the time that I joined Positive Real Estate. So I came into, I joined Positive because I wanted to expand my portfolio and get some mentoring and coaching and guidance to be able to do that.
Yep.
So I came in with these big plans to build a property empire, and we got pregnant. So another one of not an unusual circumstance for people. So another not a roadblock, maybe a speed hump in the journey, and then had a baby, and interesting story. At 6 months old, we went on a cruise from Singapore to Hong Kong. And this was just when COVID was coming, and we were one or two ships in front of the COVID ships. You might have recall all the COVID ships. So we were running in front of them, and so we just made it back to Australia just in time.
Wow.
January 2014, and then it all hit the fan.
It did.
For everyone. So so that was interesting. So that there I was with a young child in a 2-bedroom apartment in the Melbourne CBD. Not as bad as it sounds, actually. Wasn't able to go out anyway, because we had a young one at home. But interesting times, and yes.
Did you add to your portfolio at all during that time?
Well, so the where the story moves on from there, we're still involved with mentoring. Going to the mentoring, we moved online, obviously, with all of that. Wasn't really in a position to build a portfolio, but I think there was a couple of pauses, obviously, in the lockdowns with COVID, and I think we snuck a bus tour in there at some stage, which was great. And one of the stops along the way was Liberty One, which is in Footscray.
Yes.
And I think one of the lessons is take opportunities when they arise, and there's some good deals that Positive put in place, so we jumped on that one. I think that was 5% up front, only 5% deposit, and the cash back there, and there's a 2-year off the plan. And I like to take a little bit of risk, even though I worked in credit risk management, so I can weigh it all up. But I said, 2 years I'll have the wife back to work. And we'll be able to settle on this, and all the while, luckily I was in banking, so the essential services, I was still earning an income. We were still saving money, putting money away, not as much, obviously, with a little one. So we had some cash, and then another. I think it was probably 6 months later. So it was probably around 2019. I think I signed up for another off the plan as well, at the same time in Canberra with Positive 71. Which is right in the middle of the Canberra CBD in the Parliamentary Triangle. Now 5% up front and 5% 12 months later. But these are diversify my risk a little bit. And 2 years to sit on that and wait for things to move along. And in the interim, another thing, because I love to, I don't like having my money sitting there doing nothing. There's a nice joint venture that you guys did in Wynnum West. So I had 2 years. That was going to last about 12 months. I thought I had some cash, threw $100,000 in there, put it into my wife's name because she wasn't working, tax benefits, etc. Did quite a few things. So I didn't sit on my hands.
No, that's awesome.
For all that period,
Yeah, because I know Jason and Sam talk about that, about the cost of lazy equity and taking. There's risk and there's risk, right? You understand risk being in risk management, and you understood, there were a couple of protection mechanisms around that Liberty One deal, because it was a 5% deposit. You had plenty of time if you needed to come up with the other 5% in stamp duty. There's the and/or nominee clause in Victoria, which meant that if you couldn't settle, we could find another purchaser. So there was that safety net there. There was cash back, which made it particularly attractive. So the developer had put in an incentive. I think it was around 30 grand.
I think mine was 20. There's a couple depending on.
Depending on the price point of the purchase. And I think there was also a 5% rent guarantee as
Correct,
well,
yeah.
wasn't there?
Yeah.
Yeah. So, which when you're in the middle of COVID and you're seeing all the rents having a bit of a dip, it was really nice for people having that safety net. So there was kind of protection mechanism for you there. And then for the Canberra one, how did that go?
In terms of how's it performed, or what was the
Yeah, how's it performed?
Yeah, look,
What's that
so look,
done?
I think another lesson that we can get from me is around diversification. So
Yeah.
Canberra did really well. Footscray didn't do as well, but Canberra did really well. We paid, I think it was off the top of my head, $454 perhaps for that, something like that.
Yep.
2 year off the plan, and the valuation came in at $535.
Oh, that's awesome.
Yeah, so nice bit of uplift on there. So
Yep.
we were able to lend. I was able to lend 90% of the purchase price.
That's cool.
Without having LMI, because
Yeah.
the bank were able to use that valuation for their
That's
LVR.
awesome.
Those rules have unfortunately changed now, so you can't do that. APRA squeezed down on that little one. But that helped me with the Canberra deal, the Footscray deal, which settled a little bit later, which came in a little bit short. But also, as part of my risk management, I had these other properties. I had equity in those as well. So I knew I had that fallback position. So obviously, everyone has different risk tolerances, and they're in a different place in their journey. So you do the deals, or look at the opportunities that fit within their parameters as well. So I took a little bit of risk, but calculated risk.
Awesome. And, a lot of people say, oh, does positive real estate only do off the plan? It's like, no. We do, our acquisitions team are actually tasked with a 33% split of house and land existing and off the plan. We do tend to focus on new property because new property has the tax deductions which form part of a strategy to allow people to pay down debt with the tax refunds on their incomes. So generally speaking, they're some of the key fundamentals that we have here at Positive Real Estate. And, property doesn't always perform when you want it to perform. Sometimes depending on the market, depending on the valuers, depending on their perceived risk in the market, not everything comes in either on valuation or above valuation. And recently we've been seeing some crazy valuations. We had one client who bought off the plan. Can't remember the purchase price of the property. It was probably about anywhere between 800 and 1.2 mil. It wasn't off the plan. And it was an apartment. So for those that say apartments don't get capital growth, how would you have experienced capital growth in an apartment? And this one came in, I think, 400 and something thousand over valuation. So a lot of it is due to the feel of the market. And at the moment, the Melbourne market has had a little bit of a tougher ride since COVID, but that doesn't mean that the fundamentals aren't strong. No, and we tap into Oxford economics here at Positive Real Estate, and they have 30 economists that make predictions on the market. And predictions are exactly that, they're predictions. But I do like to think that, if it's Oxford and there's 30 people all putting their opinions and they're coming up with the common theme from all of those people, those educated people, that there is some merit in it, and they've all got good predictions for not only the Melbourne market as a whole, but the Melbourne apartment market, which has lagged behind a little bit. So we're super excited, and I would envisage that you'll start to see some good capital growth there. Before we see the capital growth, we usually see an uplift in rents. How are your rents going there? Are they still flat, or are they beginning to increase a bit?
Yeah, look, so we're just in the second year of tenancy, so I think we rented for, I think it was $530 a week, so it was above that 5% rental guarantee anyway, and we got a tenant reasonably quickly. Which was good. Just had the most recent rental increase. We put it up $10, $540. There's still a couple of apartments in that building. So look, you need to wait for because when a build, obviously, as we know, when a building is built, you rent a whole lot of apartments out at the same time,
Yep.
so there's that little bit of competition.
Yep.
And then obviously they'll generally renew at the same time, but as the years go on, those renewals will move around a little bit for different reasons. So So again, it's that one's a little bit cash flow negative for me. But then I've got other properties that have matured nicely and are paying, balancing a portfolio out. So nothing out of the pocket overall.
Oh, that's awesome. And just before we move on, Liberty One, can you remember what you purchased that for? Was it for?
It was 487.5, I think. 487,000.
487. Okay, so if we go 540, I'm just interested, times 52. What I'm working out, folks, is the yield. Divided by, what did you say, 480?
487.
500? Equals, so that's a 5.76, so 5.8% yield, which is pretty awesome. So that's well above the standard rental yield in Melbourne for an apartment. So that's awesome. And like I was saying before, usually you'll see we call it yield variation. So where there's a yield variation, where the yield is higher than is normal in the market, it's usually a predictor of capital growth. Because as an investor, if I was going to buy that property, you wouldn't sell it to me at that price. You'd sell it to me at probably closer to that 540, because even then I'm getting a 5% yield, which would be a good yield for me as an investor. So it's almost showing me there's intrinsic value in that property, even though it may not have been recognised at valuation. I know that makes sense to you. Does that make sense to everyone else? So that's really cool. And it's all the stuff we teach
it's performing,
you.
I guess it's performing to expectations.
At Positive Real Estate. And so, Howard, I guess my final question for you is that classic podcast question. I'm going to put you on the spot a little bit here. If you were to go back in time and you could see 18-year-old, 20-year-old Howard, what would be the top piece of information, the top tip that you would give young Howard today?
Yeah. Look, I think it's probably a little bit different to what many people would say, which would be, get in the market as soon as possible. And that's always a great answer, get in as soon as you can. But, like many young fellas, got a little bit of consumer debt and, paying that off and then, redrawing, travelling. I travelled a lot, so I enjoyed my life. So, just, try not to spend money that you don't have. Is probably the number one tip. And that even, as for an 18-year-old, that's good advice. For a 52-year-old where I am now, it's still good advice, right? So that's probably the biggest lesson. But time, obviously time in the market as well. Buy as early as you can. Let the market do its thing.
Yep, no, I concur. I've told my story a number of times over various podcasts, and I had some money lessons to learn when I was young, and sometimes with that spending there can come a bit of shame. And I just remember I inherited a small amount of money, but to me it was a lot. It was about $40,000, and I remember my mum saying to me, "Tab, buy a property with that. Don't fritter it away." And I frittered it all away on good times and partying, and I was so intensely ashamed of what I'd done. After that, I totally changed. It made me totally change my money habits. And I met Vin about the same time, my hubby, and he was reading a whole lot of books like The Magic of Thinking Big and Robert Kiyosaki's Rich Dad, Poor Dad, and all of that kind of stuff, and which I initially dismissed as rah-rah. And
I was the same. Like, I know Jason, on one of his Facebook ads said, I always thought Robert Kiyosaki was full of it. Until I actually had a look at it. And, I was similar, the whole American experience of, very rah-rah. And I actually only read the book. I had a 3-month break from work before I started Positive, and I actually only read the book there and thought, a lot of it actually makes sense. A lot of it, it's there's still a little bit of rah-rah, but, there's always some good lessons in any of those sort of things. You got to just be able to dig a little bit deeper sometimes to just relate it back to yourself. So,
it's that... keeping that open mind and just picking the bits that suit and work for you. And for anyone that knows me now, I'm probably the rah-rah queen. Nothing makes me happier than a bit of a dance break and some rah-rah. Not everyone's cup of tea, but if younger me could see me now, I'd think she'd roll her eyes and be appalled. But, that's sometimes how it goes with age, isn't it?
Yeah, exactly.
Awesome. Well, anything else that you felt like you needed to share or add for anyone thinking about investing or getting cracking?
No, look, I think the only other part of my journey that we didn't really touch on was my final purchase. So I've got 5 investment properties plus my owner occupier. So I ran out of borrowing capacity in my own name, and I had some good amount of money in self-managed super funds. So again, another deal through Positive, a townhouse off the plan in Brookwater, Ipswich, Queensland. Again, I love Queensland. Good land tax thresholds in Queensland, particularly for a couple. But this one was in my SMSF, so another great deal as well there. I only settled less than 12 months ago now, I think, but that was another cracker. So diversification again. Now I've got 5 properties in 3 states, or 2 states and 1 territory, in Canberra. Different structures. So being able to maximise your borrowing through different ways. So another good lesson for people out there.
Awesome.
It's not necessarily the right thing for everyone, but it worked in my situation. So it's pretty much got me to my goal. So I'm in consolidation phase for now, but you never know. Lots of wonderful property out there to maybe snap up. We'll see how we go.
Yeah, I think that's one of the hard things being at Positive Real Estate. You get a bit itchy when you see all the deals. I think just give me some quick numbers on Brookwater. What did you buy that for?
Good question. I think it was 685, something like that. 3-bedroom with multi-purpose area, nice little study area. Beautiful property. Haven't seen it, but the renders and the photos look great. And again, valuation 01 came in at 830.
Ooh, that's awesome.
So another great result, 20-odd% in, I think, 18 months, 2 years, something like that.
That's amazing.
Renting at 800 a week again, something like that. So
wow.
Again,
perfect for super.
Yeah, perfect. Yeah, so beautiful.
Yeah, now you're making me itchy. I need to go out and
we've got
buy something else.
More townhouses coming up, but they're a little bit more pricey, obviously, these days. So.
Yeah, the market's moved.
But they're good product. I think my tenant's very happy. Yeah, I'm very happy, obviously, with that as well.
Happy tenants, happy Howard. That's what we like. Exactly. Awesome. Well, thank you for sharing all of that today. I really appreciate it. And I know it's really helpful for people to hear other people's experience and how everything went and what's worked, what hasn't, and what to expect with their investing. And that, it is normal to have some hiccups along the way of our investing. And I guess what we aim to do here at Positive Real Estate is to help limit the mistakes we make in the market when we're learning by trial and error. Because like yourself, Howard, I did the same. I spent a lot of time learning by trial and error and then really sharpened up what I was doing in my time here at Positive. So, it does make a big difference learning from the collective and the collective information. Yeah. Awesome. Fantastic. Well, thanks so much. And next podcast, I will have another one of our coaches with a very different story to Howard and a very different investing journey. And we'll be talking to him in the next fortnight as well. So stand by for that. Otherwise, thank you, Howard, so much for being here today. And that's it from us today, folks. Bye for now.
Cheers. Thanks, Tab. Bye all.
Hey, thanks for listening to Property Investor Tales. Remember to subscribe so you get notified every time a new episode drops. As you can guess, I love hearing people's property investor tales. So if you'd like to share yours, then please get in touch with me via email at propertyinvestortales@positivementor.com.au. We would also love your feedback, and I would appreciate a 5-star review over on Apple Podcasts or Spotify. Remember, you can watch all of these podcasts over on YouTube at Positive Mentor or at positivementor.com.au. Until then, take care, happy investing, and bye for now.